Right. Good afternoon. We can start the discussion that we were continuing on financial crisis. In fact, we have discussed a reasonable length of information with respect to the financial crisis and factors causing the financial crisis in our last discussion. And also, to some extent, we touched upon the so-called the mother of all financial crisis. This is the Great Depression. What is interesting here is the magnitude of the asset and wealth and related declines in the Great Depression period would be smaller in comparison to 2008-9 financial crisis, but the severity and the damage to the living standards across the advanced economies was very severe, because the world was not necessarily globalized to the extent, but the damage was so huge during the period of the Great Depression. But what you are basically seeing here is again the details in terms of how different assets and its values have deteriorated across this period in US, and of course and the similar experience was available across majority of developed economies during this period. And we went on discussing this, and then we have come to the global financial crisis of 2007-9, where the peak was in the 2008. But what you are basically seeing is different the developments in terms of financial innovation, right? And then we discussed about CDOs, how these debt obligations were designed, and through which you can circumvent a great deal of underlying assets that values these financial products. But unfortunately, when you try to unearth the underlying assets of these financial products, it appears that it circles and comes to the same point in which has originated. So the way in which the financial innovation has worked, of course, helped many risk aversions and possibilities, but not necessarily the clarity in terms of underlying assets for most of these collateralized debt obligations that we have seen in this part, this period of time. And we have discussed these housing bubbles. Then I think we have come to the the point where the housing prices and things which basically contributed for the collapse. But we will kind of start from where we stopped in terms of application, right? So what we are simply seeing is you saw how this crisis was initiated, and how this crisis has spread across the rest of the world, starting from a subprime segment of the US financial system, and then the linkages to rest of the world. And then even we discuss about the so-called bubbles, housing bubbles, which formed where you have actually seen with empirical evidence in terms of the charts where the pricing structures have changed across this period. And what happened here is the real estate prices continuously taken one-sided the development where the prices were continue to rise in US, particularly in the early part of 2000s and latter part of 1990s, where the demand arising from low interest rate regime continuously maintained and substantively accommodative monetary policy and the other policy related circumstances. On top of that, there were other elements also, the demand arising from rest of the world, where the newly emerging market economies started acquiring a lot of assets in US, and this also helped continuously one-sided direction in prices to increase in the housing real estate markets in US, and also the sharply deteriorated credit evaluation practices prevailed during that period in US. So there were a lot of agency problems there. The agency problems where the executives often looked at their profit and the number of transactions that they enter through which they are returned in terms of the take-home benefits being modeled. So the structure itself was formulated to kind of call it as originate to distribute. Okay, any financial intermediary does not hold the a loan it creates or originates, but distribute them to other financial institutions after they have been repackaged and converted. Okay, so that's why we were discussing about this financial innovation, because you had different class of clientele, credit groups, where they have borrowed funds from intermediaries and invested in different mortgage products, but the receipts being again pooled and sold off to another financial intermediary and raise the required capital volumes, and again a new mortgage real estate production, if not development, has taken place, and this again sold to another segment of clientele and again repackaged and distributed. So the problem here is the agents were always trying to maximize and divert the possible credit quality there, to make sure that their benefits are linked with the number of real estates and number of products that they generate in this exercise, whereas the principal, the investor, also benefited at early stages by looking at the return it generates to the financial intermediary, but gradually building up of riskiness, and then with the sudden stoppage of increasing prices has exposed all these mortgage borrowers to kind of default, not necessarily all, but mainly the low quality subprime clientele. So this is started like distributing across other segments of the mortgage market, and the mortgage market has started defaulting their obligations to the financial intermediaries. Financial intermediaries had problems because the collaterals that they have had for their financial loans and things like that is losing value and continuous decline in prices, and then they had to rely on another financial intermediary. That financial intermediary's books also become weak, so it spread it out. Okay, then of course given this circumstance, even whoever wanted to have a mortgage in US at that time had little incentive to disclose all his true circumstances, because the drive was such that the agents were somehow selling, and the circumstance also helped them, simply because they have seen that the market participants, if any mortgage borrower default, he can just leave the key and move out. So the mortgage firms just refurbish it and sold it to a much more higher price than what it was. That was during the periods of the drive. But unfortunately, with things turning around, everybody started defaulting, and this has spread it out across the rest of the US economy, right? And then of course the further worsened the agency problems, because financial intermediaries ratings started coming down, and as a result their cost of financing also increased. And here the information problem, as we were repeatedly highlighting, the information asymmetry has widened, and the parties who are there for the transactions are not ready to accept even the little information available. They looked at them with doubt. So the entire financial structure was not necessarily having a so-called market making function. Market makers, that means for any assets, financial assets, at any given moment of time, you should be able to quote buying as well as selling prices. But here everybody is not quoting buying side of the prices, it's quoting basically the selling prices. Even if they quote buying prices, it is widely dispersed in terms of the spreads, right? So larger spreads, I mean, you see buying and selling, small gap would be always welcome in financial market. That shows the competitiveness of those assets. But unfortunately, during this problematic period, the spreads were widened, and then of course so-called information problem. Even with that information, market is not ready to digest all the information available. Okay, and the bubble, and a bubble is very severe when it bursts, and the burst is also become substantively painful when you see the burst happen when the credit conditions also tighten. And if the bubble in the first place has created through credit push, that means substantively credits channeled price increases in any segment of asset classes, right? The pain is very high when it bursts, when the credit conditions also become tighter, right? So you usually monitor when you are in financial supervision, financial regulations, or generally you are in treasury management, you look at the general pattern of the credits being channeled to different economic activities. And if you see that continuously the credits being channeled to one side of economic activity, the risk is increasing, right? So your diversification has weakened because you are pushing all your assets, right? You are just throwing all your assets into one class of assets. And if anything happens to that, your entire financial intermediaries' health become questionable. So you see, I mean, the housing, real estate, these assets were partly, prices were pushed through the credits channel to these segments prior to this problem. But when the bubble burst, the credit condition also worsened because the Fed Reserve from one side started tightening some of the policy policy interest rates. That's the kind of the point where market started feeling a little pain, and subsequently with balance sheets, with the credit rating going down and all other problems, the borrowing cost of most of these agencies also increased, and the collateral they had also losing value. The wealth has come down significantly during this period across the globe. So this is a kind of circumstance that everybody felt and faced in advanced economies, and the spillovers to the rest of the world, emerging frontier and developing market economies. Even in Sri Lanka, there were a lot of discussions in terms of the spillovers, where the credit lines extended by global financial intermediaries or the counterparty limits had by these local financial intermediaries have come down significantly. If not, even if they had a little counterparty limits, the conditions, terms and conditions of those agreements have widened, right? So these were the kind of problems that the world was facing during this problem. And as I was highlighting to some extent in previous slides, the balance sheet started deteriorate across financial intermediaries. And you see the balance sheets weakening means further write-downs. Even the assets that you hold in your balance sheets, but if balance sheets itself become weak, become not worth to hold any longer. So you have to write down. Then you take that hit into your balance sheet. Okay. And then, of course, you have to sell assets, fire selling. Okay. Because you don't see any value in these things, and you also not see any recovery in prices of these assets. So you expect tomorrow, so 1 week from now, 1 month from now, there is no recovery in sight. So you expect these assets prices to further go down. So you try to sell now. So everybody is selling. That's the problem here. Nobody is buying. So when you see something like this, the asset prices further go down, and what's the value that you recover also become very little. And then, of course, credit restriction. Even if somebody wants to buy, if not a loan being asked, you become very careful now, because you are not sure whether you are making an adverse selection there. So you are very mindful in that exercise, and you are not sure whether the party who is asking a loan is having a real moral hazard consideration. So there are a lot of restrictions on the part of credit during this time, and then the result is all these big names started collapsing, right? Bear Stearns, Fannie Mae, Freddie Mac, Lehman Brothers, Merrill Lynch, ARG, Reserve Primary, Washington Mutual. September was, in 2008, September was a very painful month for the global financial markets. Okay, so then you see the US rescue packages were debated during this period. Any questions? You can write down if you have questions on these, but you can raise questions also if you want to clarify anything on these aspects. We'll continue discussing, and you can raise questions at any time, right? So you see the so-called the problems in the financial markets during this period, and then the US policymakers also debating how best they could deal with. I mean, it's itself kind of, you create a moral hazard possibility by bailing them out. But the problem here is you cannot take that out from this circumstance, and the government has to kick in with substantive support measures to the economy during this period. And these are often termed as counter-cyclical policy measures. When the business cycle is going down, you are countering by introducing policy measures to kind of prop up the economy by creating demand or buying assets, because everybody is selling, so somebody has to buy. So the Treasury and the central bank, Federal Reserve in US case, started kind of looking at these assets. Despite the poor asset quality, they started accumulating some of these in their books, right? So even the proposals initially came in for a kind of a very big 700 billion package, bailout package. First, this has been watered down by the parliament in the case of US House of Representatives. but again passed on October. September, October, within 2 weeks, the circumstances changed and everybody started feeling the panic and the pain of financial problems. And again, another package. They thought markets are recovering, but no, they had to give another boost to the economy with almost $1 trillion package. But these numbers that you are now looking here on this slide looks smaller in terms of what the central bank and the US Treasury ultimately ended up in terms of supporting these industries and the economy. And even now, in today's context with the COVID-related and global economic downturn, the packages that they are talking is in trillions of dollars, not billions of dollars. It's in trillions of dollars. And it's not a financial crisis, but it is a significantly health and then the global demand in terms of shrinking of economies due to the pandemic and related measures. And then, of course, the questions were regularly asked, so-called creation of collateralized debt obligations, CDO, involves a corporate entity called as SPV that buys a collection of assets of different asset classes, including financial assets, real estates, mortgage-backed securities. Okay, and they had separate payment stream, as I was describing to you all, in terms of high credit-worthy segment, lower credit-worthy segment, junk credit-worthy segment, different credit classes, right? Some are high-quality borrowers, but still they also felt the pain. But the first hit came through junk credit segment. They are not necessarily the people who had permanent income at times. They have also had problems in terms of illegal migrants, also had assets, mortgage facilities at that time, as per the details now unearthed. So what you are simply seeing is the low asset quality classes started feeling the pain first, and that was spreading out like a cancer to the rest of the economy. So this was the kind of, you know, discussion on that. And this further describes about the CDO for your information. Okay, so these highest rated tranches that I was mentioning, when the trouble happened, you need to pay them first, and they had the least risk. So because they are quality borrowers. But what happened is, when you see a financial product, when the markets are, I mean, across the board getting the hit from the poor quality assets, and then of course continuous decline in prices. Okay, so even the super senior tranches had their payments being honored on time. So this was seen across most of these markets. At the lowest tranches, they had the problems anyway. Okay, and they were only paid after settling all their obligations. I mean, it's like a liability. When you have a liability, you settle everything first to the external parties before you share things with ownership, equity holders. It's like that. Okay, so most of the time what you have seen is these are financial products. When you put them in the market has not even looked at these lowest tranche CDOs, and that's become not possible to sell like what they were doing prior to these problems, right? It was selling like very liquid financial assets prior to these problems. But when the problems happened, so-called lowest tranches of this conduit, the CDOs, are not being able to sell to anybody, and everybody started kind of, you know, basically, I mean, not buying. They all try to sell even what they had during this period. And here you see the housing prices. You can see 2006 second quarter, that's the peak housing market was reaching at that time. That's where more or less the problem started. Of course, beginning of 2006 itself, it started feeling a bit with credit conditions started tightening, right? So you can see in the curve also, it's flattening there. So the normal trajectory of continuously rising from beginning of 2000s to 2000, early part of 2006, see the housing prices on annual basis increasing more than double-digit numbers, right? From 60s in 2002, hitting about 100 by 2006, the very beginning. So you can see normally in US, the interest return also very low. I mean, you probably see it's about 2 to 3%. So what you are basically seeing here is a very high return for investments in real estates. But then with the housing market reaching the peak and the financial crisis starting from subprime, you can see the 2006-7 market was moderating, and then as we have already discussed, even the policymakers thought that this is a mild recession at the very early stages, and subsequently only they have recognized the severity of the problem. And when they started to look at it in that way, the market start its kind of nosing down, I mean basically collapsing here, and many efforts here try to kind of build some confidence also failed, and markets continuously collapse until number of measures by early 2009s to kind of build some confidence in terms of bailout packages and the quantitative easing programs, QE programs during this period in US. That created some sense of market making, in a sense, the buyers coming in, and buying was also partly in terms of such assets being purchased by policy authorities itself. So you can see the kind of behavior of these assets during this period. And then even inside the Federal Reserve in US, there were arguments. Was the Federal Reserve to blame for the housing price bubble is one of the questions even today they were kind of opposing. Why they were posing this? Because some economics have argued the low interest rate policies maintained by the US Central Bank in the early part of 2000 has created a bubble in the housing market, because you have maintained very low interest rates, and this has wide implications in creating a poor credit quality lending across the board. But it's not necessarily something you can conclude on that basis. Just because you maintain low interest rates, you cannot conclude that you have to loosen, if not kind of relax your credit evaluation criteria. That's a different ball game altogether. But what happened in US is basically this has created substantial liquidity. Cost of financing were very low, and the credit quality also deteriorated in some asset classes. And the Taylor's argument that low federal fund rate led to low mortgage rates, that's drive anyway. When the market rates are low, that also spill over to other interest rates in the economy, including the mortgage interest rate, and also higher liquidity in the market. This stimulated housing demand, right, and encouraged the issuance of more and more subprime mortgages. Okay, and as a result, because you see every time there's a demand in the market, both of this low interest rate and credit to housing markets has pushed continuously the housing prices to increase and a bubble to emerge, because this bubble, in the sense the asset prices continuously increase, also due to a continuous credit facilitation in the process. So these were the kind of arguments put forward by some economists during this period. But then, of course, the Fed Reserve, the central bank, argues, okay, saying that not necessarily the lower interest rates regime, but what is interesting here is the proliferation of new mortgage products, right? New financial products being created, and that lowered the mortgage installments that the market participants has to pay, relaxation of lending standards, okay, that more buyers into the housing market, and also uncontrolled, if not not necessarily properly managed capital inflows to US from emerging market countries, because those countries were anyway exporting to US. They get a lot of demand from US for their economies. You can go back and see numbers for this, and you probably see most of the countries, including Japan initially, then subsequently China and rest of Europe, and even the emerging market in rest of the world, and started exporting a lot to US, and US was a net buyer from rest of the world. And as a result, these countries were accumulating foreign reserves, and these reserves were invested back. And the firms and the people who are getting this income also started demanding assets in US. So this has created uninterrupted one-sided price increase across real estates in the US. This was the argument chairman of Fed Reserve at that time, Ben Bernanke, was highlighting. This was after 2007-8 that he took over the Fed Reserve. Prior to that, it was Mr. Greenspan, Alan Greenspan. He was widely hailed, but unfortunately, with the financial crisis, he has fallen from his recognition. So this is what even the top-notch central bankers, carriers looked because of the financial crisis. Okay, and the debate over whether the monetary policy was to blame for the housing price bubble is still continuing. I mean, as I was mentioning, even today, arguments for and against with respect to these kind of a financial housing price driven financial market kind of a stress being argued for and against in literature. So you can see these type of developments across the board. These are the details. You can see what happened to the stock markets here. So you see here, the early 2000s, there was a dot-com bubble-related crisis in stock prices. So some readjustment of stock prices during that period. But then from 2002 onwards, like, it started again recovering, and it actually very much come to a peak, or if not the 100 in the index value by 2007 October. But then you are seeing from 100 to almost more than half has been collapsed by the financial crisis. Okay, it's become less than a half. So what you are basically seeing is the wealth across the board has deteriorated. So wealth is a function of many things, and after all that, you recognize the fact that the higher the wealth, the demand for financial assets is positively always related. So when you see this type of a thing, what happens to the economies? And demand for assets have more or less reduced significantly, and the economy started feeling the pain, and this took long to recover and reached again the hundreds like index value by 2012, if I'm not mistaken. And there were false start here and there, recovery and then uncertainty and then recovery, but gradually then moved on from there onwards from the empirical information that now you can see. And then of course spreads, you see, generally the spreads where you can figure it out, reasonably higher credit quality BAA against treasury cost of financing. The general spread was around 2% prevail in early 2000s, and this has increased by more than 3 times to 6% like during the peak of. That's what I was highlighting, the fact that credit conditions, credit constraints, and even the financial intermediaries could not get into financial flows into their balance sheets and books because of the spreads were widening, and some improvement since then with efforts put in place by the policy authorities, including bailout and quantitative easing packages and asset purchase programs, and also to some extent so-called moral suasion, where you talk down markets to kind of reduce the spreads, and this also helped to kind of ease the spreads after the peak in 2008, latter part, the second half of 2008 like. So you can see these developments, and then these dynamics that we were talking across the advanced economies, as we were discussing and highlighting, did not stop there. It spread it out to emerging market economies, where then the initial phases of emerging market economies, there were arguments in terms of mismanagement of financial openness or the financial liberalization and the global financial inflows, and the US low interest rates regime maintained had also spillovers to the rest of the world, because some US investors and the funds basically the institutional investors, they look at investing in rest of the world because they were also looking at return. When the US interest rates were low, the return was low, and they wanted to have some balance in terms of investments in emerging market countries where the interest rates are reasonably competitive, and they came and invest in those assets, and these countries haven't had much of a strong background in terms of supervision and to some extent financial market infrastructure and expertise to kind of manage lending booms deriving from assets being purchased by US funds in those economies and funding flows to those economies, and they are borrowing from those advanced market at competitive interest rates because they were maintaining a low interest rates structure. So there were a lot of arguments for this, but it is not necessarily fair that the emerging market economies supervision and regulatory structures were weak. I don't think it is that easy to kind of conclude, simply because even the advanced economies, so-called advanced economies, they had problems. They had problems in their supervision. They haven't seen the signals of the crisis coming in until it hits some of the top financial intermediaries, and even the rating agencies could not see those coming. And even the day before the Lehman Brothers collapse, they were maintaining Lehman Brothers at investment grade, right? High investment grade. I mean, there were a lot of arguments for and against for this type of discussions. But what we are basically seeing is, yes, some mismanagement of financial liberalization and openness was seen across emerging and frontier market economies. And domestic banks, as I was mentioning, also started borrowing from foreign banks because the rates were competitive and they could source funds, because those foreign banks also wanted to invest some of their liquidity in rest of the world, because they are also looking at possible return, higher returns than what they used to see in terms of these markets. So they also started kind of lending out to the rest of the world. Okay, and also the exchange rate prevailed, if not practiced, in most of these countries during that period was reasonably fixed. Okay, so when the exchange rates were reasonably fixed, if not managed, right, what you are basically seeing is as the foreign funds are flowing into these emerging market economies, the exchange rates were not adjusting in line with the inflow of foreign assets to your domestic economy. And when that happens, of course, the return also adjusts. It's like this. So when you bring in foreign currency, you exchange that foreign currency to your domestic currency at the exchange rate prevailing at that point of time. Okay, for instance, you brought in a US dollar to Sri Lanka and the exchange rate prevailing is 185. So you convert $1 to 185 rupees and get this rupees and invest in assets. If you do not let the inflows to adjust and you try to manage there by seeing that foreign funds are flowing into your economy, okay, when such circumstances, this 185 that I'm mentioning now has to appreciate. Okay, so if that appreciation happens, 185 would move towards 180, 175, whatever. So when the foreigners, when they wanted to take back these assets, right, they can take the return that they have invested in domestic economy in rupees, okay, and what they have to do is convert back into the foreign currency and take it out. So they are getting the rupee interest rate plus the original conversion now being invested in the domestic economy. When they are taking back, what happens there is they are carrying back dollar for 175 or 180 converted. Originally they got 185. So for 185 they invested, they received that 185's interest income, and they have now converted again back to the US dollar at appreciated. So they are getting more dollars for same rupees they invested some time back. So this further entice these foreign funds to come and invest in your domestic economies at times of managed environments being practiced. But interestingly, what you are basically seeing here is these economic agents bringing this money according to these arrangements. They have seen that the economies in the frontier and emerging markets were trying their best not let their currencies to adjust, particularly not let their currencies to depreciate when currencies are moving out. Why? Because when it's depreciate, same 185 that they have converted, when they are taking back, they need more than 185 to get a same dollar, right? So let's say 190, 192, right? So I'm just taking example here based on prevailing exchange rate for Sri Lankan rupee for a dollar. But interestingly, during that period, across the world, some practice of a fixed, if not managed, exchange rate prevented market taking its own position in terms of demand and supply forces, and the whoever brought money felt that their risk of market movements being taken care by this exchange rate regimes prevailed at that time. So that also contributed to some extent the countries to get hit at this point of financial stress felt in advanced economies. So these are, like, possibilities and actually happen in the crisis times, not only during this period, but across different periods of crisis in the global history. So you see the possibilities on that basis. Okay, and here also banks played a very important role because securities markets, if not direct financial structures, were not necessarily that developed in emerging market economies. Even in the case of advanced economies, still it's indirect. Financial intermediary based financial structures are the dominant provider of external funds to the firms and house economic agents. And in emerging market economies, it is more towards indirect finance, not necessarily direct finance of equities or debt issuances and things like that, because of the market infrastructure and things like that. So this is the kind of initial period of financial crisis in the emerging market economies. Then we can see other paths in terms of how the financial crisis was spreading out. Okay. Then there were questions posed by some of you. Actually, the argument there is why you have not bailed out Lehman Brothers. You have let Lehman Brothers to collapse, right? And then they started bailing out, helping out. It's not only Lehman Brothers. There were other financial intermediaries, big financial firms, including Merrill Lynch, AIG Insurance. They also be not necessarily bailed out. They have let those agencies to feel the financial crisis and apply for bankruptcy. But interestingly, why US has not necessarily acted when the Lehman Brothers was in severe distress. At that time, they also had arguments, moral hazard. I mean, they do all the kind of risky activities without properly evaluating their financial positions and collaterals, lending practices, and everything that they could think of, only because of so-called principal agent considerations, because they are going behind profit maximization. And if we bail them out, they will not take the lesson in terms of, because they didn't expect in the first place this to be this severe, would spread out across rest of the economy, rest of the world. That's one possibility. And at the same time, you probably see even the efforts to bail out even the Lehman Brothers by purchasing out by other big financial conglomerates also required some assistance from the government at that time. So they were discussing the bailout package in the US House of Representatives, but that did not go through. And immediately after the collapse, they started looking at the severity of the problem, the panic it created in the economy, and the distrust it has spreaded to the rest of financial intermediary in the US and across the rest of the world. So they started kind of rethinking the strategy and the way forward in terms of how best they have to approach and introduce some policy inducement in terms of supporting the weaker assets by purchasing from the market itself, and also injecting liquidity uninterruptedly, not only to the financial intermediaries but also to other economic agents in US. I mean, this is very challenging kind of decisions, if I'm not mistaken. For sure, you also could read some of nice books being written on this. I have few with me. I'm in and offs. When I travel, I used to read some of these. But at the same time, you see, there are a lot of articles, a lot of stories, movies you can watch if you can download some of those stuff, and it's widely available. So what you are basically seeing is, it's not that US don't want to bail out Lehman Brothers initially. They looked at that very seriously, but unfortunately, they also have not viewed that as a kind of a strategy at that time, due to possible moral hazard, agency related problems, and the bad precedents it could create. Because you will see a lot of other discussions coming up in coming lectures with respect to lender of last resort, too big to fail. There are a lot of things that we will be discussing. So they initially had little reluctance in using taxpayers' money to bail somebody who should have taken responsibility for his own actions. But unfortunately, they immediately felt it is not only limited to Lehman Brothers, but it's linked to the rest of the economy, and then of course to the global financial system. So they stepped up aggressively there onwards. But we are now looking at the emerging markets. We discussed about the first phase of these problems, and now we are seeing the other sides of the emerging market problems. Other one big and important imbalances were noticed is in the fiscal side. Okay, in many of the emerging market economies, the fiscal side had little space to maneuver, because what they see is, if you wanted to introduce and act upon counter-cyclical policies, you need to have some space. If your budget deficits were managed low and reasonably across the duration, you can let budget deficit to increase a bit at times of business cycle decline, or the crisis like this, where you can contribute some bailout, if not buybacks, whatever. But when you already in very difficult circumstance in terms of your deficits, okay, so what that creates is government in needs of funds to such activities, and required to finance through banking sources of funds, either printing by the central bank, or for that matter, channeling the credit which could have been channeled to more or less effective production sources in the economy by other financial intermediaries, the money creation. So that also possible, right? Or they must be forcing these agencies to purchase government debt. So it is not necessarily effective utilization of resources that you own, right? So because of the fiscal problems, the problems of government to fiscal side to go and help out these troubled industries or the segments of the economy during financial crisis was felt in emerging market economies. Okay, so from another perspective, you know, debt deflation, we discussed about that. So the debt also loses value, and the banks also lose their collateral in that sense, because when you buy a debt, you get the security into your books. It is a paper-based security. So the prices reduce when the interest rate increase, you know that. So when the interest rates are increasing across the world during this period, credit spreads and things like that, so naturally the assets had in your books also reduces value, and as a result your net worth that also decreases. So this was witnessed across these agencies during this period. Okay, so then additional considerations during this period of time, as you already seen, interest rates particularly from foreign sources that you are borrowing, those interest rates started increasing because of the spread increases even in advanced economies because of these considerations. And then of course you also seen de deterioration of credit quality. So naturally the whoever lend you also place additional premium for whatever the difficulties the world is going through at that time. So you have to kind of face these challenges. Then you see asset prices, as you have seen previously also when it comes to government debt in your books, asset prices also decreases across the board. So your collateral loses value. You had liquidities, you had bonds, government securities, other private securities, then real estates as collateral, all losing value. So as a result, the prices across the board decreases in the market, and then the uncertainty in terms of the political systems also, because the challenges in those economies you probably seen during 2008, 9, 10, how many times the governments were changing in Italy, Spain, mainly in Southern Europe. You just go and see how many times those countries had to face these very difficult circumstances. Greece, number of countries. I mean, those countries all had problems during this period because of the challenges coming from the financial crisis. And they had to cut down significantly of their government expenditure. Even the salaries, pensions were reduced. Austerity measures, very simple word everybody was using. Austerity, right? So the emerging markets were feeling this pain, right? Any questions? Right. So you are seeing the initial stages of these crisis in emerging market economies. Then you move into another segment of the experience in the emerging market economies. That's the currency problems. Okay, so the deterioration of bank balance sheets triggering currency crisis, it's one aspect. Okay, so what happened here is to kind of prevent a possible the weakening currency driven spillovers to your balance sheets, you could increase interest rates. So what happened is your interest rates are now higher than rest of the world. So the investors, if not even amidst challenging circumstances of a financial crisis, some investors could relocate some of their assets to your country because your interest rates still remain attractive compared to others. But what happened here is when you increase interest rates, that has other repercussions, mainly the balance sheet problems for most of these economies, because you already see the higher interest rates means lower the prices. So further deterioration of your assets in the balance sheet. So there are a lot of problems, and also from another perspective, because we were talking about manage, if not fixed exchange rates. So when the country is having a pull out by foreign investors taking the money out from your economies, you have to kind of loosen your exchange rate that you were maintaining. So it is kind of, creating speculation that you will devalue. It's not depreciation. When you manage, if not a fixed environment, it's not appreciation or depreciation of your currency. When you have a fixed exchange rate, it is revaluation or devaluation. Devaluation is losing the value, revaluation is gaining the value. So what you are basically seeing is speculators build the expectation in the economy to devalue, because your currency seems now under pressure, because people are taking foreign assets out. Foreign money is flowing out from your outflows are increasing at this period of time, right? So you have to adjust 100 for foreign currency. Then after a point, you make it like 120 for a same foreign currency. So the people who speculate expect these adjustments and take the foreign currencies invested in your economy out, expecting they will have a devaluation gain at any time soon, so they can come back and get 120, right? So this is like a speculators kind of, aiming at your currency to weaken faster, and that itself create your currencies to weaken. It's like you are expecting inflation, and inflation then come and knock your doorstep, right? So it's fastening your kind of movements towards the devaluation in a kind of a fixed exchange rate environment. Okay, then the severity of fiscal imbalances, that again triggers currency crisis. Oh, so what happened here is the foreign and domestic investors, they do not want to hold assets in domestic currency. They try to kind of accumulate foreign currency and hold, because they know the possibility that your currency will weaken, and as a result you will get more domestic currency if you hold in foreign currency whatever the assets that you can hold on to. Okay, so this again create not only the challenges to the budget or the fiscal side of the equation, but also to the balance sheets of private balance sheets of firms and stakeholders, right? So if you had liabilities in foreign currency, now the liabilities look bigger. You will come to that point. You will probably see that in a kind of environment where the full-fledged financial crisis is felt in emerging market economies. So they had this debt burden in terms of domestic currency, as I was mentioning, now increasing, because you had obligations, liabilities, foreign borrowing in your books, right? So those foreign liabilities still remain same in foreign currency. So the foreign values that you have booked in your books, it is $10 million, it's $10 million. But what you require now is more domestic assets to service the same 10 million liability in your books, because your currency has weakened. Earlier it was 100, now it's 120, right? So 100 into 10 million, now 120 into 10 million. So see additional 2 million requirement, a 20 million requirement, because 100 to 120 adjustment. So it's like further your balance sheets get weakened because of these problems. Domestic currency based liabilities in your books now increases to service same obligations that's built in foreign currency in your financial assets, financial books. Okay, and then the increase in expected and actual inflation, right? So when you see the difficulties, the production cycle is also weakening from one side. That means supply side also get some weakening, and as a result, the goods sorry, and services available in the economy also shrink. And then another aspect is, because your currency is weak, imported elements are now costlier. So this also speed up the expectation in terms of inflation increasing, and as a result actual inflation also increases, and this creates kind of further problems to firms cash flows, right? So you cannot change prices, and if you increase the prices immediately, you will see further reduction in demand or the ability to sell goods and services to the people who are already reducing the demand for these. And this is like in a situation where the business cycles are weakening, all these could further weaken the business cycle. So that's why counter cyclical policies come in. Government create demand in the economy by introducing projects, introducing asset buys, and through which it's let the economic agents to have access to resources to demand goods and services in the economy, through which you can manage. But we already know the space for emerging market economies was not there in the first place to introduce counter-cyclical policies, right? Even if they had a little space to introduce counter-cyclical policies. So you see all this culminating a fully fledged financial stress across emerging market economies during these periods. And then the financial intermediaries, they're more likely to feel the pain and to fail, okay? Because people who borrowed from them are now in difficulty. Their assets values have come down, okay? The obligations that they have to honor to the banks are looking extremely challenging given the economic circumstances, okay? So what happened here is the loans in your books are losing value. Even if they have defaulted, whatever collaterals you are now taking into your books, banks call the collaterals, but unfortunately collaterals also losing value. Then from another side, the foreign currency debt that you are holding in your books, your value of those liabilities are increasing because you have to pay those. For that, you generate income from your domestic currency sources. If you have foreign currency sources, fine. That's the natural hedge for you. But unfortunately, it's not one-to-one matching in most of the financial intermediaries, right? So in the first place, you are motivated to borrow from foreign because the interest rates in foreign were slow, right? So you had those circumstances prior to the crisis. But with the financial crisis, the circumstances have changed. Those parties were pulling out the money, right? So your obligations that you had and your currency is now weakened. So your circumstance is also different and your liabilities would look much bigger in such circumstances. So this is the biggest challenge the financial intermediaries felt during that period of time across almost all the emerging market economies. So you are now seeing everything that we were discussing, like in advanced economies, sequence of events in emerging market economies also during the financial crisis. Stage one, initiation of these crises, you had the deterioration in financial intermediaries' balance sheets, interest rates were increasing, asset prices were declining, uncertainty that also increases across the board, and these all culminate to the adverse selection and moral hazard circumstances. And what happened here is lending contracts become much more tighter because of these possibilities. So adverse selection and moral hazard possibilities increase in any circumstances mean even the intermediaries who are looking at the lending contracts, they also start tightening the lending arrangements. So the ability for you to come out from the challenge is become much more challenging now, because financial intermediaries also tightening the lending contracts. And in the stage 2, the currency crisis, this could come from fiscal imbalances, as you are already seen, and the foreign exchange market related. And this also create same adverse selection and moral hazard problems. So you further become concerned with any further lending, and the contracts become tighter. And then the fully fledged financial circumstances that you are feeling now. So you see the economic activity across the board declines. So what happened here is, when the economic activity declines, the banks also feel their assets are declining value, the collaterals losing their values, and their liabilities look big. Then that further creates adverse selection and moral hazard problems, and lending contracts become tighter, and economy would further move into the kind of decline, if not recessionary circumstances. So what you are basically seeing from all these discussions of financial crisis in the advanced economies, emerging market economies, all these drive towards so-called adverse selection and moral hazard possibilities, and the lending contracts to be further tightened. So you understand how important in financial market in terms of information asymmetry being addressed. So all the problems arising in financial intermediation and financial markets is mainly because of these possibilities of you are selecting the wrong part in the first place, and then of course the moral hazard probability, where the parties who receive financial intermediation act beyond the risk tolerance levels and the spaces expected of them, right? So it is not their money, principal agent problem. You had all these things. So this further creates difficulties in terms of defining lending contracts in the financial market itself. So you can now nicely kind of coin the story behind the financial crisis in both advanced and emerging market economies. So we also look at some other, very briefly, some other crises had prior to these financial crises. There were also some examples of similar developments. But any questions? Any further questions that you have? Right. So we can continue. So you see, prior to this crisis in 2007-9 period, there were also some financial related difficulties in Mexico. That was in 94-95 period. Then you see in East Asia, where you probably heard of Asian tigers. They call them tiger economies in East Asia. Those economies were fastly growing and fastly moving into industrialization at that time. And this was during 97-98 period. And then in Argentina in 2001 2002 period. But what you are basically seeing is some very similar circumstances, but not to the magnitude of global in nature. In Mexico, the problems were to some extent financial liberalization in early 90s. So as a result of this, they had a lending boom, credit expansion. Okay, but it appears that they could not have supervision and other regulatory aspects being covered. If not, they haven't had the expertise to do such a supervision related consideration. So lending has gone into weak segments and low credit quality sources. Okay, and then once they started kind of defaulting, banks started accumulating losses and their net worth started declining. The interest rate reversal in foreign countries also contributed to some extent here, because when the lending boom was happening, it is mainly financing coming from foreign countries also into the Mexicans. That means inflows. But then what happened is when the interest rate started increasing, the same inflow could not be continued, and you have to honor, then you had to borrow at costlier rates. Okay, then they had the political aspects of the equation, where the uncertainty also prevailed in the Mexican economy at this point of time. Okay, so then the currency management, to some extent they managed a fixed exchange rate, so they had to devalue because of the currency pressures. Okay, and as a result, both actual and expected inflation. So you have seen all these things. So they felt these problems in Mexico in mid 90s, and latter part of 90s you have seen East Asia. They had very open and liberalized financial systems in early 90s. They introduced these changes, so they are also had a large inflows coming into their economies. As a result, a lot of credit expansion, but they also had the problem of expertise and supervisory and regulatory concern. Okay, so the banks started the kind of a difficulties when the lending, their loans were not necessarily honored. So it started accumulating, and one element here is, in the case of East Asia, sometimes the arguments were that the lendings were directed and politically patronized lending. So the lending were directed to parties who are politically affiliated. If not, and you probably seen in history, if you have read or read through the crisis, the lending were channeled to the people who are in power and they are close kith and king, if not relatives or close associates. Okay, so there have a lot of concerns here, and the uncertainty to some extent here is due to stock market and also failure of big firms. Those are also related to the political authority and closely linked to their affiliates. So this was the kind of a circumstance across East Asian countries, and they also had to devalue their currencies because of some fixed exchange rate that they have practiced. And then you see inflation is increasing across these economies too, right? So Argentina, their problem was that, I mean, they had forced the banks to borrow, if not buy government debt due to fiscal difficulties. And as a result, their balance sheets lost balance effectively. And as a kind of a consequence of increasing interest rates, mainly in the foreign countries, the inflows also become costlier, and they could not sustain the same inflows into their economy. Okay, then they also had the economy anyway not doing well. They had recessions across the board, and it's also created the economic recovery, and then the currency was devaluated. and the inflation actual and expected. So what you are basically seeing is it's repeating despite all the experiences, the challenges that the world has gone through. It's repeating. So what the argument here is, end of the day, with all these experiences now we are talking, there is no guarantee or assurance that another financial crisis would not come in the future. Best we could do is we could learn and try to understand what drives these circumstances and the bubble formation being managed. If you see that the asset prices are continuously increasing, you have to have a close eye on what's driving these asset prices. Is that the real demand? Is that the real economic activities, or it is really a credit driven or inflow driven? Inflow also could be all right if it is coming for real economic activities, right? So that's where the countries are now much more concerned with, and we are heading towards a topic which would try to kind of answer some of these regulatory and other related concerns that we have raised in this segment of the discussion. So with that note, we can conclude the financial crisis section. Any questions on this? Right. So we can move to the next topic of discussion. I think you already have the handouts accessible for you all through the system. If not, you all have already taken these for your usage. So basically, I mean, these segments talk about financial regulation, the economic analysis of financial regulation. As you have seen in our previous discussions, not only the financial crisis, but other topics also that we have already covered. Now you must come to the conclusion that the financial system in any economy is among the most heavily regulated sectors for various reasons. I mean, other sectors also regulated. Telecommunication, IT, defense, even consumption, whatever you call it. But what you are basically seeing is the financial industry or the financial systems have much more proper, if not formal, a system of regulation than most of the other segments of the economy. And among these financial intermediaries or the participants in the financial system, the banks, right? So the banks remain, again, mostly regulated among all these financial market participants. Other elements also, for instance, insurance agencies, finance and leasing agencies, yes. Even microfinance agencies, yes. They also to some extent regulated, but banks are much more scrutinized and closely regulated. So in this section, we try to develop an economic analysis of why regulation of banking takes the form that it does in today's context. And not necessarily in today's context, but also we look at the possibilities that the regulation in terms of the future requirements of the financial intermediaries also. Okay, but when you say regulation, you have to also understand this regulation may not necessarily work well all the time. Okay, so if that's the case, you should not necessarily see any banking crisis or any financial intermediary failing. Okay, as you have very clearly seen from a number of discussions we had and recent evidence in the financial crisis and the problems in the banking systems and financial markets across both advanced and emerging frontier developing economies. Yes, the regulation is there, but it's not necessarily a kind of, make that a foolproof and no problems in the financial markets. It's not the conclusion that we wanted to arrive at, right? Here we also use our economic analysis of banking regulation to explain some of the worldwide crises in banking and how regulatory system can be reformed. That's what I said, to prevent such possibilities in the future. There were some discussions to that effect in financial regulation considerations in the this section of the discussion here, right? So you know now asymmetric information. It is not symmetrical. Parties to the transaction are not necessarily having same more equal amount of information, and also even if it is available, the ability to consume them equally is not the case. It is like food is available, but some can have more, some can have less, some have constrained by difficulties, health related or other, right? But at the same time, right, various types of food. I mean, this asymmetry is a very important element that drives the importance of regulation in the financial markets, financial systems. Okay, then you see the experiences of this regulation in terms of its importance and the requirement to be forceful has some elements of bank panics and the desire to introduce deposit insurance. Bank panics, people are pulling out all their deposits, they are queuing up. You can see the picture here, the run on the bank. Right? So the bank panics create economy-wide uncertainty about financial intermediation. Nobody will trust when the bank panics start that their finances are secured, and the first thing you would do is you would rush to take the money out. Can the bank honor? There are asset and liability mismatches for sure. Liability is your deposit in the bank size. Asset is all the investments, loans, and other things. Can they have all that ready by the time you're queuing up in front of the bank to take them home? It's very challenging. And there's liquidity problems also. But interestingly, deposit insurance, FDIC, Federal Deposit Insurance Corporation in the case of US, that short circuits bank failures. It reduces the possibility of people panicking and also the failures and the spillover, so-called contagion effect. Okay, this could be in the form of a government safety net for depositors that could short circuit run on banks and bank panics. You have a safety net. Okay, if you fall, you will not get injured and you will not fall to the ground because net will save you. This is the safety net. So similarly, the depositors are given some assurance or some confidence that their deposits are safe, either through bank or other arrangements, and then this could actually help prevent, if not reduce the probabilities of bank and bank panics, runs on bank and bank panics. But interestingly, the deposit insurance arrangement also create the confidence among stakeholders in the economy on the financial intermediation. Right? It can overcome the reluctance to put funds in the banking system. But when a bank come to a kind of a difficult circumstance and the deposit insurance schemes kick in, there are various ways of addressing some of these. One is the payoff method. So it's a paying off the liability in order of priority. To pay off your obligations. There may be liabilities which are pari passu, if not equal with others, if not the priorly settled with senior tranches that we were talking about in some of the CDOs, something like that. So liabilities in order of priority. If not, there are various ways through purchase and assumption method. That is like reorganizing the bank. You purchase and you let others to purchase, the conglomerate of banks to purchase, okay, and then assign arrangements. Like you cannot withdraw, they can impose some restrictions. You cannot withdraw more than 10%, 20% of your for a period of 12 months or whatever. So there are ways through which they try to address. And on top of that, there could be other forms of government safety net. Okay, central banks could come and lend to troubled financial institutions who have liquidity problems, who have asset and liability mismatches. This is again, central banks could come in and help them as lender of last resort, where everybody else in the market are not ready to lend to this financial intermediary. So it's a central bank who will lend, who will act as the last resort for these financial intermediaries to get their liquidity support and other assistance. Okay, so you can actually see introducing a safety net to avoid or prevent possible bank panics and bank runs, but the safety net itself has so-called moral hazard probability. Why I say moral hazard? Okay, you know what moral hazard is. Moral hazard occurs when one person takes more risks because someone else bears the burden of those risks. And the banks themselves start taking more risks because they understand the central bank or the government would take risks to protect them. The godfathers are there to protect them. So why should I bother too much about all these lending nitty-gritties and the contracts? So I'll be a little relaxed because I earn more principal agent problem by having more mortgages being facilitated. So it's a moral hazard on the part of banks when you see a safety net being established. Not only that, right? The moral hazard may occur where the actions of one party may change to the detriment of another after a financial crisis transaction has taken place. Yes, you know that at the time of the contract, you are the best. You basically reveal everything, you highlight everything, you disclose the details and the collaterals you provide. But since the transaction's been completed, even finding you, even your response to approaching you through whatever source, it becomes very big, challenging, difficult. And the assets that you have kept, you neglect them. You do not maintain them. You overuse them. There are various ways of moral hazard that could happen. And also because of the safety net, even you as a depositor in the bank become lazy, okay, and complacent, that you would not look after what this bank is doing for my money. Because you see, if anything happens, I will fall not necessarily to the ground because the net is there. Net would save me. Okay. So because of this reason, the so-called safety net creates the moral hazard where the depositors do not impose discipline of the marketplace. If there is no safety net, you will run and withdraw your money as soon as you hear this bank is doing a wrong transactions. But because safety net is there, you are now not bothered. You are not imposing discipline, marketplace discipline. And the financial institutions, they are now seeing, okay, central bank is there, government is there. If anything happens to the financial intermediary, they will help the depositors. They become complacent. They take more risks. They only look at the return side of the equation. So you see the plus of safety net and the negatives of the safety net now. And its possibility, it enhances the moral hazard both on the part of the depositors, also on the part of the institution. Any questions? We will stop at this point and we will come back next week if you don't have questions here. And we can continue, and most likely we can move on to another segment, maybe central banking. We might look at it and its arrangements in the next class. Right. If you don't have questions, we will stop at this point and we can start the discussion next week. Thank you.